Swayam Prabha. Digital India. Educated India.
Yogah Karmasu Kaushalam.
Hello students, I Dr. Dhaval Nakum from Gujarat University welcomes you all for the subject Financial Accounting. Today we are going to cover the remaining parts of unit number 1B, that is capital, revenue, deferred revenue expenses, reserves, provisions and contingencies. Let us recollect the discussion from the previous part. Previously we had a discussion about types of accounts where we discussed capital, revenue, deferred revenue expenses. Then we have covered the understanding of types of account with some illustrations. Then difference between capital income, expenses versus the revenue income and expenses. And lastly, we have covered the practical understanding on capital and revenue transactions. And then we have covered provisions and reserves with their meaning, objectives, features and importance. In this part, we will discuss about some remaining topics pertaining to the difference between the revenue reserve and capital reserve, then secret reserve, then difference between the reserves and provisions, and then contingent liabilities and assets. Now, in continuation of the previous part, let us understand the difference between reserves, revenue reserves and capital reserves. Difference between revenue reserve and capital reserve. The very first point is source. In case of revenue reserve, it is created from profit and loss appropriation account, whereas in case of capital reserve, it emerges from capital profits. The second basis is usage. In case of revenue reserve, it can be used for the distribution of dividends without any legal restrictions, whereas in case of capital reserve, generally it cannot be used for the distribution of dividends, but it can be used for the distribution of dividends only if the company satisfies certain conditions prescribed by the Companies Act. Third basis is purpose. In case of revenue reserves, it is created for strengthening the financial position and meeting unforeseen contingencies or some specific purpose like the expansion of business. Instead of creating funds from external sources, these internal sources can be utilized. Whereas in case of capital reserve, it is created for meeting capital losses or to be used for the purpose specified by the Companies Act. For example, the capital reduction reserve can be utilized for bonus share purpose as provided in the Companies Act. Fourth base is nature. In case of revenue reserve, it is a routine activity and may be created every year from the profit of the current year, whereas in case of capital reserve, the frequency of such reserves is not routine in nature. The last and fifth point is association. In case of revenue reserve, it is associated with revenue transactions, whereas in case of capital reserve, it is associated with capital transactions. Generally, specific reserves are invested in profitable opportunities because these reserves have a specific objective linked with future cash outflows. For example, a debenture redemption reserve is created for the redemption of debentures with a fixed time period, that is, for example, after 5 years. In such situations, the business will create a reserve and invest in investments. At the time of debenture redemption, these investments will be sold and the debentures will be repaid without disturbing the present cash flow. It is important to note that a reserve and a debit balance in the profit and loss account or the statement of profit and loss cannot exist together. In the balance sheet, the net amount should be disclosed. If the debit balance of the profit and loss account is more than the reserves, then the debit balance of the P&L account shall be shown on the asset side as an accumulated losses, and if the reserve amount is more, the difference would appear on the liability side of the balance sheet as the balance of the reserves. Now, the second point is secret reserve. When any asset is disclosed at less than its real value, or when liabilities are disclosed at more than their real value, the difference is a secret reserve. A secret reserve is a reserve whose existence and or amount is not disclosed in the balance sheet. It is also called a hidden reserve. Essentially, there is a surplus of assets over liabilities, and this surplus is not disclosed or shown in the balance sheet. Sources of the secret reserves. For example, if the required depreciation provision is rupees 10 lakh, but rupees 12 lakh is provided, the profit and loss account is debited by the amount of rupees 12 lakh. Being a non-cash expense, there is no effect on cash outflow. Fixed assets will be shown at a lower value in the books while their market value is higher, thus creating a secret reserve. Another example is pending court case listed as an actual liability of rupees 5 lakh rupees when it is a contingent liability. In brief, any unreal transaction that increases the total of liability side or decreases the total of the asset side would create a secret reserve. It has certain benefits like increase in working capital and financial soundness, can be useful in any unfavorable situations, set off of heavy losses without having public disclosures, etc. But these are unethical practices. On the other hand, there can be negative effect on the market value of the share. Final accounts will not disclose true and fair view. Shareholders will deprive to get true return on their investments and are disadvantages of the secret reserves. As per the provisions of the Companies Act, any joint stock company is prohibited from creating secret reserves, but exceptions are applicable for financial institutions such as banks and insurance companies. Let us close this discussion with the example of difference between reserve and provision. Difference between reserves and provision. The very first aspect of difference between reserve and provision is nature. In case of reserve, this activity is done after preparation of P&L account. It is an appropriation of profit, whereas in case of provision, this activity is a part of profit and loss account. It is a charge against profit. Second basis is purpose. In case of reserve, it makes sound financial position of the business organization. Its use is not restricted in any manner. It can be used for any purpose like unexpected losses. Whereas in case of provision, it is a precautionary step in accounting. It is made to meet known liability or contingency when amount is in uncertain and imprecise. Third basis is effect on profit. P&L account is to be prepared according to the legal provisions. It is an internal matter of management. It is debited to the profit and loss appropriation account. After preparation of P&L account, this P&L appropriation account is prepared. Hence, profit is not affected. In case of provision, it is part and parcel of profit and loss account. Thus, it is debited to the profit and loss account and hence profit is reduced. Fourth point is investment. In case of reserve, it is free from all legal restrictions. It may be invested outside the business and investments can be sold anytime in case of financial needs. Consequently, liquidity will not be adversely affected. Whereas, in case of provision, it has specific purposes and thus it is not invested. Fifth basis is distribution. In case of reserves, in case of low earnings of any year, these accumulated reserves can be distributed as dividend. It reduces divisible profits. Whereas, in case of provision, It cannot be used for distribution as profit or dividend. It is associated with certain future responsibilities that are to be performed. Next aspect is compulsion, that is prudence. In case of reserve, it is created out of profit as a matter of prudence and due to legal requirements, whereas in case of provisions, it is made because of accounting principles. The last point is presentation. In case of reserve, we can say a reserve is shown on the liability side of the balance sheet under the head reserves and surplus, whereas in case of provision, it is shown either as a liability under the head current liabilities or as deduction from the assets. Next point of discussion is contingent assets and contingent liabilities. As discussed, accounting is a science. It is based on developed principles and rules, and according to these principles and rules, only all real transactions and events are taken into consideration to obtain the true and fair results through the financial accounting, that is, results of annual or final accounts. Accounting does not deal with any possible or unreal transactions and events. Possible transactions are known as contingent transactions, but accounting does not exclusively ignore such transactions. For example, a business organization has a dispute for collection of rupees 5 lakh and it is under legal process. This collection is uncertain. This cannot be added to the business income of the business until judgment comes in favor of the business organization. Thus, according to the theory of accounting, it is contingent income and will not be added to the accounts, but it has a specific place in accounting. Now, we will discuss the features of contingent transactions. The very first feature is these are uncertain incomes or expenses. The second is these are not entered in the books of accounts. Third is these are treated as unreal transactions. Fourth is these will be finalized after completion of legal processes, if any. Fifth is these would appear in the books of accounts as note, but will not become the part of all legitimate calculation. They will not be treated as either income or expenses or assets or liabilities. Sixth, these can be either in favor of or against the business organization as a contingent asset and contingent liability respectively. Seventh, these are disputed transactions. Eighth, the decision or settlement of contingent asset in the favor of the business unit is beneficial to the business because here ownership of asset will be of the business only. Ninth is the decision or settlement of contingent liability in the favor of the business unit is beneficial to the business because here no liability is to be paid. Now, we will cover contingent assets. A contingent asset may be defined as a possible asset that arises from past events and whose existence will be confirmed only after the occurrence or non-occurrence of one or more uncertain future events, which are not wholly within the control of the enterprise. It usually arises from unplanned or unexpected events that give rise to the possibility of an inflow of economic benefits to the business entity. For example, a claim that an enterprise is pursuing through a legal process where the outcome is uncertain, it is a contingent asset. As per the concept of prudence as well as the present accounting standards, an enterprise should not recognize a contingent asset. These assets are uncertain and may arise from a claim which an enterprise pursue through a legal proceedings. There is uncertainty in the realization of the claim. It is possible that recognition of contingent asset may result in the recognition of income that may never be realized. However, when the realization of income is virtually certain, then the related asset no longer remains a contingent asset. A contingent asset need not be disclosed in the financial statements. A contingent asset is usually disclosed in the report of approving authority that is board of directors in case of a company and the corresponding approving authority in case of any other enterprise. If an inflow of economic benefit is probable, contingent assets are assessed continually, and if it has become virtually certain that an inflow of economic benefits will arise, the asset and the related income are recognized in the financial statements of the period in which the change occurs. Next point is contingent liabilities. The term contingent liability can be defined as a possible obligation that arises from past events and the existence of which will be confirmed only by the occurrence or non-occurrence of one or more uncertain future events not wholly within the control of the enterprise, or we can say a present obligation that arises from past events but is not recognized because of certain reasons, like it is not probable that an outflow of resources embodying economic benefits will be required to settle the obligation, or it can be a reliable estimate of the amount of the obligation cannot be made. A contingent liability is a possible obligation arising from past events and may arise in the future depending on the occurrence or non-occurrence of one or more uncertain future events. A contingent liability may also be present obligation that arises from past events. An enterprise should not recognize a contingent liability. A contingent liability is required to be disclosed unless the possibility of outflow of resources embodying economic benefits is remote. These liabilities are assessed continually to determine whether an outflow of resources representing economic benefits has become probable. If it becomes probable that an outflow of future economic benefit will be required for an item previously dealt with as contingent liability, it should be recognized. Now, the distinction between the contingent liabilities and liabilities. The distinction between a liability and a contingent liability is generally based on the judgment of the management. A liability is defined as the present financial obligation of an enterprise which arises from past events. The settlement of liability results in an outflow from the enterprise of resource representing economic benefits. On the other hand, in the case of contingent liability, either the outflow of resources to settle the obligation is not probable, or the amount expected to be paid to settle the liability cannot be measured within sufficient reliability. Examples of contingent liability are claims against the enterprise not acknowledged as debts, guarantees given in respect of third parties, liabilities in respect of the bills discounted, and statutory liabilities under dispute, etc. In addition to present obligations that are recognized as liabilities in the balance sheet, enterprises are required to disclose contingent liabilities in their balance sheet by way of notes. The distinction between contingent liabilities and provisions. It is important to know the difference between provisions and contingent liabilities. The distinction between both of them are following. Provision. Provision is a present liability of uncertain amount which can be measured reliably by using a substantial degree of estimation, whereas a contingent liability is a possible obligation that may or may not crystallize depending on the occurrence or non-occurrence of one or more uncertain future events. Second point is, a provision meets the recognition criteria, whereas a contingent liability fails to meet the same. Third point is, provision is recognized when an enterprise has a present obligation arising from past events, an outflow of resources embodying economic benefits is probable, and a reliable estimate can be made of the amount of the obligation. Whereas contingent liability include present obligations that do not meet the recognition criteria, because either it is not probable that settlement of those obligations will require outflow of economic benefits, or the amount cannot be reliably estimated. Last is, if the management estimates that it is probable that the settlement of an obligation will result in outflow of economic benefit, it recognizes a provision in the balance sheet. In case of contingent liability, if the management estimates that it is less likely that any economic benefit will outflow the firm to settle the obligation, it discloses the obligation as a contingent liability. Let us take an example to understand the distinction between provisions and contingent liabilities. The GST officer imposes a penalty on Param Limited for a violation of provision in the GST Act. The company appeals. If the management of the company estimates that it is probable that the company will have to pay the penalty, it recognizes a provision for the liability. On the other hand, if the management anticipates that the judgment of the appellate authority will be in its favor and it is less likely that the company will have to pay the penalty, it will disclose the obligation as contingent liability instead of recognizing a provision for the same. Let us undertake some practical to understand capital, revenue, deferred revenue expenses, reserves, provisions and contingency through illustration. Illustration: how would you classify given information as a capital or revenue expenditures and receipts and deferred revenue expenditure? Question number 1. Insurance company paid claim of rupees 50,000 for furniture destroyed by fire. Answer 1. It is capital receipt because these rupees 50,000 are received for furniture which is destroyed by fire. Furniture is an asset and amount received for any asset is capital receipt. Question number 2. Rupees 50,000 travelling expense is paid to the engineer for foreign visit for purchase of machine. Answer: any expense associated for acquisition of asset is capital expenditure. Here, travelling expense is pertaining to asset, hence it is capital expenditure. Next, rupees 25,000 received on maturity period of 3 months for trade receivables. Trade receivables means amount of credit sales. It is pertaining to sale of regular business. Since it is income of regular business, it is revenue income. Next, the company has 35 years old building and was demolished to construct new building. Rupees 1,02,000 paid to the contractor to demolish old building. An accountant has debited this amount to P&L account. Do you agree with the accountant of the company? Answer is no. The opinion of the accountant is not correct. It is preliminary work to construct a new building and it is associated with new building. Thus, it is capital expense. Next question. R and Company Limited had acquired machine of rupees 40 lakh on 1/4/2018 having estimated life of 10 years. On 31st March 2024, machine became obsolete. Unfortunately, machine can realize only rupees 6 lakh. Rupees 10,000 loss is debited to P&L account. Is this correct treatment? Yes, it is correct treatment. It is to be treated as revenue loss. Loss arising out of obsolescence of machine is revenue expense or loss. Cost rupees 40 lakh less depreciation 2018-19 to 2023-24 for 6 year is rupees 24 lakh. So, written down value at the end of 2023-24 is rupees 16 lakh less realizable value is rupees 6 lakh. So, rupees 10 lakh which is loss and its nature is revenue loss. Next question. Wages paid for installation of plant and equipment rupees 18,000. Any expenses incurred related to asset which is required to put respective asset in operation is capital expenditure. Next is festival advance to employees of rupees 5 lakh rupees. This is not expenditure, it is an advance. Next is entrance fee of rupees 5,000 received by Orient Club from members. Here, entrance fee is not recurring in nature. It is received at the end of acquiring membership of the club, thus it is capital receipt for club. Government given subsidy to a small manufacturing unit for working capital rupees 5 lakh. Here, working capital is needed for day-to-day transactions and it is subsidy not to be returned back to the government. Thus, it is revenue receipt. Next question is advance paid to supplier for supply of goods rupees 10,000. It is advance but not an expense. When goods will be supplied by supplier would become capital expenditure. Next is if repair cost is rupees 50,000, whitewash expense are rupees 10,000, cost of extension of building is rupees 5 lakh and cost of improvement in electric fittings is rupees 38,000. What amount should be considered as revenue expense? Here, any extension cost and improvement cost always are increasing capacity, thus they are capital expenses and rest are revenue expenses because they are concerned with maintenance. So, rupees 60,000, rupees 50,000 plus rupees 10,000 are revenue expenses. Next is Ramesh paid rupees 10,000 to obtain license to commence manufacturing unit. State nature of transaction. Here, this expense is one time expense to commence business. This is treated as capital expenditure. Next question. Some specific parts of engine are replaced for rupees 30,000 for getting fuel efficiency. These expenditure would increase efficiency of the engine, thus it will be treated as capital expenditure. Next question is a building construction contract is obtained and material of rupees 20 lakh used on site. At the same time, for storage purpose, temporary hut is prepared and spent rupees 32,000. How would you treat with cost of hut? Building construction is fixed cost, means capital expenditure, and cost of hut also will be treated as capital cost because hut is needed due to this construction only. Next is rupees 1 lakh is recorded as debenture discount in balance sheet. State nature of this expense. Here, debenture discount is treated as deferred revenue expenditure. The benefit of use of debenture is not confined to 1 year only. Next is contingent assets and contingent liabilities are possible loss and benefit to the firm respectively. Is this correct statement? Here the answer is no, this is not correct statement. Contingent asset is possible benefit and contingent liability is possible loss. Next is an accountant of the company is in the opinion that contingent liability should not be recognized in the financial statement. Give your opinion. Here an accountant is correct. It is not matured liability, so not to be recognized in financial statements. Next is a company incurred an expense for TV advertisement and agreement is done for 3 years. Amount paid is rupees 3 lakh. What is the nature of expense? Here it is deferred revenue expense because benefit of this is available to the company for 3 years. Every year equal amount will be transferred to profit and loss account. Next question is how would you deal with provision during preparation of final accounts? A provision is a charge against profit for the purpose of providing for any liability or loss. Next is reserve is not liability in real sense. Do you agree with this statement? Answer is yes, agree with this statement. It is accumulated profit which can be distributed amongst shareholders in the form of dividend, but yet not distributed to them. Next is capital reserve may be in the form of cash receipt and may not be in the cash form. Is it correct statement? Answer is yes, it is correct statement. If an asset has book value of rupees 50,000 and sold for rupees 65,000, difference is capital reserve generated in the cash form. An asset of rupees 75,000 is valued at rupees 85,000, so difference of 10,000 rupees is not generated in the cash form. Next is whether provisions are internal transactions or external transactions. Here provisions are internal transactions. It is managed by company within itself. No external parties concerned and affected with these transactions. Next is what is depreciation provision? Depreciation provision is charge against profit. Next is a company has provided rupees 45,000 for general reserve. Explain accounting effect of it. Here provision of general reserve is appropriation of profit only. In this part we had discussion about difference between revenue reserve and capital reserve. Then we have talked about the secret reserves. Then we have talked about the difference between reserves and provisions as well, and we have talked about the contingent assets and liabilities, and then illustrations on identification of nature of given transactions. In next module we will deal with new topic, accounting concepts, conventions and principles and accounting standards. Keep on refreshing, discuss topics and wait for new and very interesting topic. Thank you students.